Welcome to the deep dive. We've sifted through quite a sack of sources today, all focused on a real heavyweight in India's financial world, ICICI Bank.
Absolutely.
Our mission, as always, is to cut through that noise, pull out the key info so you get the essentials fast.
That's the plan. By the end of this, you'll have a solid grasp of ICICI Bank, its past, its present, its numbers, maybe even a few surprises along the way.
Right. So to really get ICICI Bank, you kind of have to go back, way back to 1955.
Yeah, the Industrial Credit and Investment Corporation of India, ICICI.
Exactly. It started as this joint venture, believe it or not, with the World Bank.
Focused purely on financing Indian industry back then.
But the big shift, the real transformation, that came later, right? October 2001.
That's when the parent company, ICICI Limited, merged into ICICI Bank.
And that wasn't just moving boxes around, was it?
No, not at all. It was a fundamental strategic pivot. They moved from just, funding big projects to becoming a universal bank, diversified.
Why was that so important?
Well, think about it. Relying on just one thing, like project finance, can be risky. Market ups and downs.
Sure.
Diversifying gave them resilience, made them much stronger. And then building on that, around 2010, they went hard on digital.
Oh, yes, the digital-first strategy. And they really went for it.
They certainly did.
We're talking iMobile Pay, 28 million users now?
Over 28 million, yeah. And the transaction value is huge, nearly 9 trillion rupees in FY23.
Just staggering numbers. And then there's InstaBen, too.
1.5 million active business users.
Yeah.
Plus their FASTag market share is what, almost 30%?
Around 29%, yeah. So how does all this tech translate into, a business advantage?
It's all about operational leverage. That's the key term.
Okay.
Basically, digital allows them to handle way more business, serve millions more customers, without their costs shooting up proportionally. It's efficiency, pure efficiency.
Giving them a serious edge over competitors.
It's a significant competitive advantage, definitely.
And you see this reflected in their financials, don't you? The growth has been pretty robust.
Oh, absolutely undeniable. Just look at the revenue from around 49,000 crore rupees in 2014 to over 186,000 crore by March 2025.
Wow.
And the profit growth. Compounded at 40% over 5 years, 27% over 3, consolidated net profit heading towards 55,000 crore rupees.
Incredible figures. But how? What drove that turnaround, especially with profits?
A huge part of it was sorting out their asset quality, their net non-performing assets, the bad loans.
Right.
They dropped dramatically from over 2% in 2019 down to just 0.39% by March 2025. That's incredibly healthy.
And why does that matter so much?
Because cleaning up bad loans frees up capital that was tied up covering potential losses. That capital flows straight to the bottom line, boosting profits. Plus, it makes investors feel much more confident.
Makes sense. And their capital position is strong, too.
Very strong. Their total capital adequacy ratio is over 16.5%. Core equity, the CET1, is almost 16%, way above what regulators require. It's like having a really, really thick cushion.
Okay, but we do need to address a significant issue from their past, the Chanda Kochar Videocon loan situation.
Yes, that was a major challenge. The core allegation involved a large loan, about 3,250 crore rupees, and questions about a potential quid pro quo involving her husband's company.
How did the bank handle the fallout from that?
Well, crucially, the controversy actually pushed them to tighten things up internally, significantly.
In what way?
They implemented much stricter internal audits, really beefed up their corporate governance framework, learning from the experience.
Yeah.
And a really positive sign recently was the US OCC lifting a cease and desist order this year, 2025. That signals regulators are satisfied with the fixes. It builds confidence in their stability now.
Good to hear. Okay, let's pivot to the stock itself. The performance has been, pretty amazing.
Yeah, if you look back 10 years, the return is nearly 400%.
Which absolutely crushed the Nifty 50 index, right? Which was around 200% in the same period.
Correct. So putting it simply, if you'd put in, say, 10,000 rupees 10 years ago.
You'd have almost 40,000 rupees today, roughly.
Exactly. But then comes the question for investors today. We look at it through, say, Benjamin Graham's value investing lens.
The father of value investing.
Right. He focused on earnings power and financial strength. ICICI definitely has both. We saw the profit growth, the low NPAs, the high capital. Checks those boxes. But the price you pay matters. Its current valuation. The price-to-earnings ratio is around 20 times. Price-to-book is over 3 times.
And how does that compare?
It's significantly higher than the average for the banking sector in India. Industry medians are more like a PE of 9 to 11 and PB around 1.3.
So Graham might say,
He'd likely say it looks fairly valued, maybe even slightly overvalued right now. The market seems to have already factored in a lot of that strong growth.
meaning less margin of safety for a strict value buyer.
Precisely. The upside might be more limited at this current price from a pure value perspective.
Okay, so wrapping this up, ICICI Bank, clearly a high-quality company, strong growth, leading the digital charge in India's financial sector.
No doubt about the quality. The provocative thought for you, though, is about that premium valuation.
Right.
Does its future potential fully justify paying that higher price today? Or is it perhaps a stock you watch and maybe accumulate if the market dips? It makes you think, what parts of a company's story, its quality or growth, are you willing to pay a premium for?